Hey everyone, welcome back to Vaulted Views, where we elevate your perspectives on money, business, and life. I'm your host, Lucia Jr., and today we're diving into a big, controversial topic. We are uncovering the hidden costs of index investing and why I believe a separately managed account, or SMA for short, especially a concentrated, high-conviction SMA portfolio, can lead to better long-term results. So index funds are widely seen as easy, low-cost way to invest. But there's something most investors don't realize. Index funds have hidden costs due to something called Reconstitution. Every so often, the index has to update its list of stocks. That means it's forced to buy the stocks that are being added to the portfolio and sell the stocks that are being removed. The problem? Every fund that's tracking the index is doing the exact same thing at the same time, creating price distortions. Studies show that stocks added to an index increase in price by about 4% on the 20 days before they're added, only to drop by 5.7% in the 20 days after. On the flip side, stocks being removed tend to decline before they're kicked out, and then they rebound afterwards. This means index fund investors often end up buying stocks at inflated prices and selling at their lowest points, which is the opposite of what you want to do. Remember, the golden rule of investing is to buy low and sell high, but index funds actually, with their whole rebalancing and reconstitution, force you to do the exact opposite. That's crazy. So you got to be asking, like me, what's the alternative? Well, I think it's separately managed accounts, or SMAs, which allow you to own individual stocks directly, giving you more control over what you buy and sell. Let's talk about the major advantages for a second. Customization. SMAs, they let you build a portfolio around your specific goals and preferences. Want to focus on technology, avoid certain industries, align investments with your personal values? You can do all that using an SMA, something you can't do with an index fund. Tax efficiency. Since you own the stocks individually, you can strategically sell certain stocks to minimize taxes, a technique called tax loss harvesting. This can help reduce your overall tax bill, something that's much harder to do when you own index funds. Transparency. With an SMA, you always know what you own. Unlike an index fund, which might hold hundreds of stocks you've never even heard of, an SMA lets you see and manage every individual company. Avoiding forced trades. SMAs don't have to buy and sell stocks just because an index changes. That means you're not stuck buying at inflated prices or selling at discounts like index funds do. You and your SMA manager control the timing of your trades, which can significantly improve your returns. Now, let's take this one step further. One of the biggest advantages of an SMA is the ability to invest in a concentrated, high conviction portfolio, meaning you focus on a smaller number of top quality stocks instead of spreading your money across hundreds of companies like an index fund. Research shows that most of the stock market gains, the long-term gains, come from a small handful of companies. In fact, a study found that just 4% of stocks historically have accounted for the lion's share of market's historical gains. So that's crazy. So what does that mean for investors? It means that owning too many stocks dilutes your best ideas. When you hold hundreds of stocks in an index fund, your winners don't have as much impact on your overall portfolio. Instead, a concentrated portfolio allows you to focus, or your SMA manager to focus, on high-quality companies with strong growth potential. Studies show that concentrated portfolios of, say, 15 to 30 high-conviction stocks tend to outperform more broadly diversified portfolios by 2.8 to 4.5% per year. Think about it this way. Would you rather invest heavily in your 20 best ideas or own 500 stocks, many of which are mediocre or even declining? Of course, concentrated portfolios, they come with risks too, so let's talk about those. If you own fewer stocks, any one company's bad performance can have a bigger impact. That's why it's crucial to choose SMA managers that select high-quality businesses. Many of the world's most successful investors, like Warren Buffett, use a concentrated portfolio approach. The key is owning great companies, holding them for the long term, and not overpaying for them. If done right, this strategy can lead to significantly better returns than just blindly following an index. So let's sum it all up. While index funds offer simplicity and diversification, they also come with hidden trading costs, forced buying and selling, and limited control. On the other hand, SMAs allow you to build a portfolio around your best ideas, manage taxes efficiently, and avoid unnecessary trading. By focusing on a concentrated group of high-quality stocks, you can maximize your upside potential while keeping full control over your investment strategy with your financial advisor. And that's why more sophisticated investors are turning to separately managed accounts. They understand that small edges like avoiding index rebalancing costs and concentrating on the best companies can make huge differences in long-term wealth creation. So that's about it, guys. Until next time, stay elevated, stay strategic, and most importantly, stay vaulted. I'll see you in the next episode.